Ladies and gentlemen, welcome back to the channel. Following a pretty tumultuous market today, Tom Lee says the AI trade is still intact, that people are freaking out for no reason. Here in today's episode, we will obviously share with you what Tom Lee said today about the AI trade. And what I want to do in today's episode is talk what's next for this market, for the AI trade, what you need to know into the end of this year, into next year. I've been very open and honest about this, okay? Getting the government open is step one, but just getting the government open itself is not going to cause a massive year-end rally for AI, for small caps, for hyper growth, the areas that you and I are investing in. I'll tell you exactly what will in today's episode. And there's good news likely coming on the horizon later this week. Hit that like button, subscribe to the channel, and check the link out down below in the description of today's episode. If you guys want to come join the trading community, come invest with us, come find these small cap AI stocks or smaller cap AI stocks that Wall Street is ignoring. See, there's a whole group of this market of high growth companies trading at very reasonable valuations. We're talking anywhere from 2 to 10 times sales that are growing at hundreds of % a year. In my book, that's cheap. Why? Because Wall Street is ignoring them, as simply as that. So, if you guys would like to join, link down below, but let's get started with today's episode. First things first, with what Tom Lee just said about this market. Tom Lee says the AI trade is still in very good shape fundamentally, and I agree with that, but take a listen to exactly what Tom Lee says.
Let's welcome in now CNBC contributor Fundstrat's Tom Lee. It's good to have you. Welcome back.
Yeah, thanks, Scott. Good to see you.
So the market obviously assumes that this is all going to happen, the government's going to reopen, and we're just going to get back on our merry way in the stock market. That's certainly what the trade says today. Am I right?
Yeah, I think there's a certain measure of relief because the shutdown robbed us of visibility on the macro data, and of course there's economic hit and they're suffering because air traffic is slowing. So I think for many reasons I think this shutdown was a problem for investors.
So what about now between now and the end of the year? It's the AI trade that really seems to be debated. How do you feel about it heading into this final stretch?
I think it's still in really good shape fundamentally. We know there's a lot of visibility for AI spending, and we know there's still innovation and gain of function taking place with the models. So to me, it makes sense that there's still a payoff coming. I think one of the issues that investors are going to grapple with is even though they may say AI stocks are expensive, NVIDIA still only trades at 29 times forward earnings. I mean, it's still cheaper than Costco, so it's hardly a bubble valuation.
No, but I don't think when they talk about the valuation of AI stocks, they're necessarily talking about NVIDIA. I think you would agree with me on that. They're more so talking about names like Palantir and some others where you could easily say, yes, their earnings have been great and the story's incredible, but at some point you're only willing to pay X for a stock, and maybe that one's gotten a little bit too rich. Using that as an example of the kind of names they're talking about.
Yeah, I mean, I think Palantir is an example of what they call like an N=1 company. You've got a founder-led business developing products that really seem like magic for the companies that adopt it. So, should this just be getting a softer multiple? I don't think so. And Palantir's opening up so many markets, and if it was a venture capital firm, they'd be getting, potential carry for how they transform businesses. So to me, I think that this is still a market discovering how to define the valuation model for Palantir. But to me, that doesn't mean it's a bubble. People would have said that about Tesla in 2018 because it looked incredibly expensive, and the stock in Tesla has been a huge performer since then.
But what was last week about then, do you think, at its heart?
Well, I think at the heart is the market wobbles, and so when the market wobbles, two things. One is they start to take shots at the leaders, right? Because they try to take down the leaders, thinking that's what leads us down. But the second, it really highlights the grim reality that we're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers. And so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year end.
Don't you have any concern at all about the level of money that these companies are spending on their build out, and now the new wrinkle of tapping the debt market rather substantially to help do it?
I mean, Scott, yes and no. I mean, AI is proving to be a scale game. You know, it's not like you and I could start a garage and make a model competitive with OpenAI. You know, we need to have scale and a lot of chips. That's really the model that was required for telecom infrastructure and for energy infrastructure and, of course, for internet infrastructure and even fiber. So it makes sense that a handful of players are really playing a big role. And just like in the energy system, there's 8 majors. Everybody spends money on the 8 majors, and the 8 majors pay a smaller ecosystem. So I think it makes sense that that's what's developing in the U.S. And, of course, it's leaving other countries in the dust.
Tom Lee said there was very accurate. When the markets start to wobble, I think that's a good way of putting it, wobble, then you see Wall Street try to be a lot smarter than they actually are. Let's face it. Fund managers, Wall Street, they're not very smart, okay? They're just not very smart individuals 9 times out of 10, or they're too smart. They over analysis, paralysis, everything. Okay, there's one or the other. Okay, there's really no middle ground, which a lot of you guys would fall in the middle ground. You're very intelligent, but you're reasonable. Okay, when the markets start to wobble, Wall Street starts to panic. They start to blame the hottest thing at the time. Okay, I've seen this countless times, year after year after year. It's always the hottest areas of this market. Nobody ever blames, healthcare for the reason markets are falling. Nobody blames, anything besides what is leading the market. What has led the way higher is what gets blamed. Okay, whereas 9 times out of 10, it's down but not out kind of a thing, okay? Now, what a lot of Wall Street doesn't understand, a lot of Wall Street's going to say, oh my gosh, AI valuations and this and that. No, a lot of AI valuations are quite reasonable, okay? A lot of the stocks we are investing in are quite reasonable, okay? And they have long-term growth trajectories ahead of them. What Wall Street is missing is this economy is probably not as weak as they think. See, the panic was that the government is shut down and it's going to be shut down for 50 days. Most betting markets like Polymarket and Kalshi are betting around 50 days. It looks like the government might reopen in the next day or two is kind of what it's looking like. That's one part of it. When you open the government, you stop the hemorrhaging in the economy. There's likely a lot of minor negative impacts to the economy, but one big one is flight travel. Okay, in my opinion, there's no way around it. Reducing flights and canceling flights is problematic at the core of this economy. Okay, there's no other way to put it. That is the biggest drag on the economy at this point. You're talking cargo planes, you're talking passenger planes, right? Like FedEx. You know how much shit is moved through FedEx and UPS planes? It's incredible. Okay? That is a real measurable impact on the economy. Okay, fine. So Wall Street last Friday had an expectation of negative 60,000 jobs. Well, the longer the economy stays shut down, the worse off things are. So now it looks like the economy, the government is going to open, which relieves some pressure on the economy. But now the question is the economy running at negative 60,000 jobs in October? Is that really the number that we're looking at? I'll tell you now, I got a little bit of good and bad news. Good news is, I think we're going to come in substantially lower than negative 60,000. Maybe it's negative 20,000. Maybe it's negative 10,000. Maybe it's slightly positive. That would be my thought. Okay, I think it's going to be much better than expected. That's the good news. The bad news is I don't know. The bad news is if the jobs report comes in worse than negative 60,000, this market has a whole lot more downside ahead of it. Okay, that's the bad news. But good news is I think the odds would favor you heavily if you were betting on a number less than negative 60,000. I think the odds would be in your favor, highly at that point. Because Wall Street just got so bearish and so nervous and so scared when this government shutdown looked like it wasn't ending in sight. They really had a negative 60,000 jobs number as the estimate. Now, if the government does reopen over the next couple of days, we will be getting the CPI report coming out, I believe that's Thursday. And we should be getting the jobs report by this Friday, if the government opens this week. It might take a couple days to get the jobs report. That is what we need to get this year-end rally. That is the only thing left holding this market back, is we need clarity and understanding on the state of the economy. I think there's probably an 80-ish% chance that October's jobs report was less than negative 60,000. Again, negative 40,000, negative 30,000, negative 20,000. That would all be much better than feared. And that would cause a pretty aggressive rally to the upside. Okay? Now, we're also going to get CPI this week. If CPI was better than expected, that's also very much a positive catalyst as well. But if I'm wrong and jobs numbers come in really bad, then you're going straight into full-blown recession panic. Okay? If we get a jobs report that's negative 100,000 jobs, yeah, look out below. This market is going to crash way harder than you've seen so far. I put the odds at probably less than 20% that is the outcome that we're going to get. And honestly, there's just a lot of uncertainty out there because we don't have the economic data. Look, you have here from Vios Advisors that says they're really concerned about consumer spending in Q4. And then you have here from Morgan Stanley, quote, overall consumer trends remain relatively stable. Like literally all you have to do is just look at the headlines of these clips on CNBC and you're going to see just how much volatility there is between different, quote unquote, Wall Street professionals. Okay, there's no consensus at all. People have no idea what is happening right now. I like to go off of earnings. I think earnings are a really good way of looking at this economy, getting an understanding of the consumer. And if you look at earnings, things are obviously not great out there, but they're not nearly as bad as what a lot of Wall Street is thinking, okay? Like, sure, is Chipotle struggling? Of course. But broadly, are things okay? Are earnings numbers coming in good? Yes. So there's disparity. Some areas are doing better. Some areas are doing worse. But it's largely unchanged. Same kind of earnings we had this quarter versus last quarter, okay? Versus the quarter before that. It's not a whole lot changing right now.
Yeah, I think the only thing that matters in the very near term for this market, for AI stocks, is how is the economy doing? That's the big question. Now, you do want to be specific and selective with companies you're investing in. You want companies that are growing, okay? Growing a lot. You want companies that have a large total addressable market, okay? You don't necessarily want companies that have terrible balance sheets, right? You do want to be a little bit selective in this market with AI, okay? But I think a lot of the stocks that we are investing in are going to do very well over time. We're talking Resolve, we're talking Poet, There's another one I bought today. I won't mention it in today's episode. We might make a video on it here on this channel eventually. But there's one exciting stock we bought in the trading community today. I bought 2,000 shares to start that position. If you guys want to join it, link down below in the description of today's episode. But I think a lot of those stocks are going to be very, very successful as well. And I think that's where the best risk reward is in this market. Like, do you really want to chase Google at this point? Probably not. Like that guy was saying, I mean, maybe if you're a fund and you're trying to beat the S&P a little bit, sure. But if you're trying to make outsized returns, not the greatest place to be, in my personal opinion. Obviously, I'm not a financial advisor, not a financial planner. Google's a fantastic company, very predictable, reliable, blah, blah, blah. I just think there's much better ways to play the AI trade, and that's what we're doing in the trading community. Again, link down below in the description of today's episode. But again, the only thing that matters in the near term is how is the economy doing? That's the question. The question on your mind and that you need to ask yourself is, one, question, how is the economy doing? And number two, how do you think the economy is doing? Earnings, blah, blah, blah. Like, what leads you to your conclusion? Okay. What makes you think the economy is recessionary or not? And really the question is at this point, are we damn near in a recession or are we not? And I'm going to say we're not in a recession. And there's positive things to look forward to over the next 12 months that I'm excited about, like the big, beautiful bill, a lot of tax changes in that. We're not going to get into all of it here in today's episode. We're going to wrap this one up. But there's a lot of things to be positive. Real estate market for next year, where the consumer might actually be able to recover a bit. And that's not something Wall Street talks about at all. But it's going to become a lot bigger part of the conversation as we get into next year. So hit that like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's episode. Thank you for watching. Have a great rest of your day, and I will see you in the next one.